Nelson. He's European equity strategist at UBS and one of the people responsible for this report. Now, you've cut those targets, but as I just mentioned, still year-end, quite considerably higher despite what's going on in the world. Just explain your reasoning.
Sure. So the reason for the cut was simply we thought that the P multiple people are prepared to pay for European equities is lower because of the ongoing sovereign debt issues we've got in Europe. So we took the multiple down a little bit. Having said that, the market has obviously moved very aggressively in the last 2 months. We're trading on something like 8.5 times forward earnings. So that's actually very cheap compared to history. So I still think if we're correct, and this is just a soft patch, we see upside into the second half.
Now, you've been looking at payout ratios under what you've called a black sky scenario and a grey sky scenario. Just explain what you're doing there and what you mean by all that.
Sure. So a grey sky scenario is basically a mild recession, so negative GDP growth in the US, but not aggressively so. A black skies is much more aggressive. It's a steep recession. It's similar in magnitude to some of the deep recessions we've had in the last decade or so. What we then do is we look at how much earnings will go down and therefore how much the coverage ratio for dividends change.
And you've been looking at specific industries and specific stocks of what you think will do well and do better. Now, banks have been under so much pressure over the past few months, well, past few years, I think, frankly. Top picks, Lloyds and RBS versus the bottom picks are mainly the Spanish banks, I'm guessing. What are they doing that the others are not?
Well, in theory, the view from our banks team is very much that the UK banks and the Scandinavian banks have recapitalised very aggressively, and we would say some of the European banks, perhaps particularly some of the Spanish banks, have not recapitalised as fully.
Even a giant like Santander?
Well, it's basically across the whole banking system as a whole. So we would argue that it's the continental Europeans, and in particular perhaps Spain, an area which needs more capital.
What about the mining stocks, Petropavlovsk, BHP, Glencore? They seem to be in a good position as opposed to something like Antofagasta.
Well, I think when you look across the sector, you look at a BHP, a diversified, large, and of course with the oil exposure as well, that's perhaps a better place to be for the time being. So we've stress tested these individual stocks' earnings under these difficult scenarios.
And as far as the miners that you have more of a negative outlook on, what are they doing or are unable to do to bring themselves up? Something like Lonmin Aquarius Platinum, for instance.
Well, I think in some cases you've got companies which are actually higher cost producers, or they're not exposed to the commodities where we're more bullish, and they will therefore suffer more if we have this downturn.
Now, we've seen big swings in technology stocks over the years, but you still like the companies such as Ericsson, the semiconductors, ASML. What about that industry, which can turn on a sixpence, obviously, when technology comes, or patent disputes, or M&A activity?
Well, semis are super cyclical, so I think the base case we've got, the base case scenario, is this moderate growth, and in that situation, they would probably do reasonably well. But obviously, if we were to go to this black skies, deep recession, semis would be one of the sectors where you'd want to be pretty underweight.
But isn't that where ST Microsystems comes in as well? It does the same sort of thing, am I wrong?
Yeah, well, no, you're right. If we were going to go to a very black sky scenario, then in some cases the industry as a whole would be one you'd want to underweight.
Let's looking at stocks. I mean, you take a look at dividends. They look pretty good right now for value. How long can that last?
Well, I think, look, we've had dividends go down significantly less than earnings, obviously. Companies stress their payout ratio, which is what we've done in a note the team put out at the beginning of this week, and they basically allow for some of the stretch in the payout ratio and still pay the dividend.
And sales growth and GDP, the relationship between that, and we've had so many negative reports again this morning, downgrading GDP. So as far as sales growth and earnings are concerned, that's not looking great for the future.
No, and the consensus numbers are too high. I mean, consensus are looking for 14% growth next year. We think it will only be 8%.
Nick Nelson, really good to talk to you. Thanks very much indeed for joining us on Bloomberg Today.